Hello and welcome to a discussion on how to record journal entries and balance T accounts. After viewing this video, you'll be able to record transactions and journal entries, post transactions into a T account, balance a T account, and prepare an unadjusted trial balance. A journal entry is the method accountants use to efficiently record transactions. The journal entry records which items are increasing and which ones are decreasing. Journal entries have a debit and a credit. The debit account name is written on the top and the credit account name is written on the bottom, slightly indented. The total amount of debits that are written on the top must equal the total amount of credits that are written on the bottom for each entry. All accounts have a T account that is used to record increases and decreases and get to an ending net balance that is reported on the financial statement. The ending balance is the net of the increases and the decreases. When using T accounts, the debit account is always written on the left and the credit account is always written on the right. Do not try to put a meaning to the words debit and credit. The two words are only terms used to record transactions and they have no other meaning. Debit means to write it on the top for a journal entry and to put the amount on the left in the T account. Credit means to write it on the bottom for the journal entry and to put the amount on the right in the T account. Whether the account name is written as a debit or a credit depends on if the item is increasing or decreasing. The acronyms ADI and LOCKER are used to help remember whether to record the account with a debit or a credit. Assets and expenses work the same way. Always debit the account name for an increase and then credit them if they decrease. Liabilities, owner's equity, and revenues always work the same way also. Credit these accounts when increasing and debit them when they are decreasing. These two groups work the opposite so that total debits will always equal total credits. Write these T charts and the guidelines down where you can remember it. This is the general guide to writing all journal entries and using T accounts. Assets and expenses work the same way and increase with a debit and decrease with a credit. Liabilities, owner's equity, and revenue also work the same way and increase with a credit and decrease with a debit. There are 5 steps to follow when recording a journal entry. Read the transaction and decide what items are changing and the type of account that is changing. Then decide the direction the account is changing and use your T account charts to determine if it is a debit or a credit. Then write the debit account on top and the credit account on the bottom. Your debits must equal your credits. Let's walk through the thought process. This company purchased $12,000 of inventory on account. First, decide what is changing: inventory and accounts payable. Second, decide the type of account that is changing. Inventory is an asset and accounts payable is a liability. Third, decide which direction the accounts are changing. Inventory is increasing, accounts payable is also increasing. Then, decide if the direction of the change is a debit or a credit by using your T-chart guidelines. Inventory is an asset, and assets increase with a debit. Accounts payable is a liability, and liabilities increase with a credit. Then just write the debit account name on the top and the credit account name on the bottom, slightly indented, with the amount. Let's try another one. Employees worked and were paid $3,000. Decide what is changing: salary expense because a service was provided to the company, and cash. Decide the type of account that is changing. Cash is an asset, salary expense is an expense. Decide which direction the account is changing. Cash, the asset, is going down, and salary expense is increasing. Then use your T-chart accounts to decide if the direction of the change is a debit or a credit. Cash, the asset, decreases with a credit. Salary expense is an expense, and expenses increase with a debit. Next, write the debit account name on the top and the credit account name on the bottom, slightly indented, with the amount. The next transaction. The company provided inventory that cost $10,000 to customers for a price of $15,000 on account. First, decide what is changing. Service and goods were provided to the customer. That's sales. The customer doesn't pay, so accounts receivable. Inventory is provided, it goes down, and using an asset is cost of goods sold. Decide the type of accounts. Accounts receivable and inventory are assets. Cost of goods sold is an expense, and sales is a revenue. The direction. Accounts receivable increases, inventory decreases. Cost of goods sold increases, and sales increase. Now, use your T account charts and decide if the up or the down is a debit or a credit. Accounts receivable is an asset going up. Assets going up is a debit. Cost of goods sold is an expense going up. It also goes up with a debit. Inventory, the asset, is a decrease. Assets decrease with credits. Sales revenue increases, and revenue increases also with a credit. So you've got 4 account names. Write the 2 debit account names on top and the 2 credit account names on the bottom. Then add the associated amounts and indent your credits. This is a 4-part transaction. The next transaction is that the company paid suppliers $15,000 for the amounts they owed. Decide what is changing. Cash and accounts payable. Decide the type of account that's changing. Cash is an asset, accounts payable is a liability. Decide which direction the account is changing. Cash, the asset, is going down. Accounts payable, the liability, is also going down. Then use your T account charts and decide if the direction of the change should be a debit or a credit. Cash, the asset, is decreasing. When an asset decreases, it's a credit. Accounts payable, the liability, is decreasing, and liabilities decrease also with a debit. Write the debit account name on top and the credit account name on the bottom, slightly indented. Then add the numbers. After recording journal entries, the amounts that were recorded to each account are posted into the T account in order to get the balance that is reported on the financial statements. Each asset and expense account has a normal balance on the debit side. The normal balance is always on the side that increases. Balance sheet accounts will have a beginning balance since they are cumulative. Increases are posted on the left and decreases are posted on the right. The total amount on the right is subtracted from the total on the left to get the ending balance. Let's now post the journal entries we just recorded to the inventory account. Assume the beginning balance is $11,000. 2 transactions changed inventory. Inventory was purchased and inventory was sold. The purchase recorded inventory with a debit, an increase, and the amount is written on the left side. The inventory sold was recorded with a credit to inventory, and the amount is written on the right side. Debit amounts are on the left and credit amounts are on the right for assets and expenses. The beginning balance plus the left minus the right gives the ending balance that is reported on the balance sheet. The description of what happened is not written in the T account. We do it only here to help you remember the transactions. Amounts are the only things written in the T accounts. Let's look at an example of a liability, revenue, and owner's equity T account. These have a normal balance on the credit side. The normal balance is always on the side that increases. Balance sheet accounts will have a beginning balance since they are cumulative. Increases are posted on the right and decreases are posted on the left. The total on the left is subtracted from the total on the right to get the ending balance on the right side. Now let's post the journal entries we just recorded to the accounts payable account. Two transactions changed the accounts payable account. Inventory was purchased and suppliers were paid. We'll assume the beginning balance is $25,000. The purchase on account increases the amount owed and is posted on the right. The payment to suppliers decreases the amount owed and is posted on the left. Debit amounts are always on the left and credit amounts are always on the right. The beginning balance plus the right side minus the left side gives the ending balance that is reported on the balance sheet. T accounts are used to summarize what happened for each account. It's important to remember that only amounts are written in the T account. The descriptions are provided here only to help you remember the transactions. Let's look at an example of posting to the cash T account where you can see both the journal entries and the T account. The first transaction posted on the left is the issuance of common stock in exchange for cash. Cash is an asset and an increase is recorded with a debit. The second transaction posted on the right is a payment made to suppliers. Cash is an asset and decreases with a credit. The first journal entry on the right has cash, an asset, with a debit and therefore increases and is written on the left. The last transaction is posted with a credit to cash. Cash is paid, decreasing, and it decreases with a credit. The two debit amounts are posted to the left to get the total increase. The two credit amounts are posted on the right to get the total decrease. The left side which increases cash and the right side which decreases cash are totaled, and the two are netted to get the ending balance that will be reported for cash on the balance sheet. All T accounts are posted, subtotaled, and then netted to get the final balance that's reported on the financial statements. After recording all transactions and journal entries, posting all T accounts, and balancing the T accounts, the accountant prepares a trial balance. The trial balance is a summary of all transactions recorded to date. It is called an unadjusted trial balance because it is before final adjustments are made by the accountant. Final adjustments will be discussed in the next video. After viewing this video, you should be able to record transactions and journal entries, post transactions into a T account, balance a T account, and prepare an unadjusted trial balance. Please log on to studymyaccounting.com. The practices you learn will give you examples of each of the concepts discussed in this video. Work the practice test to verify your understanding, write out your answers, and check your answers to the answers and explanations provided. Thank you for being prepared for class. It is much appreciated.